Thanks a lot.
Yeah, thanks, Vivek.
So I'll just add to the introduction which Vivek gave. Sanjay and I stay in the same building, which explains why he's here. Ravi and I think in the 90s shared a room, which is, I guess, why... Office room, yeah. He's very quick on that. He's very clear. He was married by then, so was I. So it's good to... And even more funny. Yeah. But... and I guess Rishi is here because, Rishi, you wrote a book, so you had to be here. But as Vivek said, that we've seen so much happen, but both Ravi and Sanjay have kind of experienced it firsthand and felt the impact firsthand. So let's have a pleasant conversation. Last week I was there at a private dinner where Subramaniam, who was earlier the chief economic advisor and now India's representative on the board of the IMF, was speaking about the Indian economy, and what he said was that, look, we are about 3.5 billion now. And the common narrative is that by 2047, we will be about $28 billion. And the maths it works is that, look, trillion. So the way the maths works is it becomes, roughly from 3.5, you become 7, and then 14, and then 28. And his view was that, look, we are underselling India. India is going to be not 28, but 56 trillion. And his view was that, we are growing faster. There is more formalization of the economy. And finally, there will be some amount of rupee appreciation after a long, long time. So he said, look, we're not going to be 28, but we're going to be $56 trillion by 1947. At the same time he was talking about it, I came across this article, the World Development Report, written by Indermeet Gill and his colleagues, where he argued that, look, in 75 years from now, if India is really, really lucky, the GDP per capita will be 1/4 that of the US. So US is about $85,000 odd dollars just now. India is 2,600, 2,700, 500. So he's saying 1/4. So he's saying we're going to be about $22,000 in 75 years from now. So those are two completely contrasting views about what is going to happen. And then if you kind of look at what has happened in India, and it's something which Joan Robinson said about 50 years ago, I guess, that any statement about India, the opposite is equally true. So I'm hoping we're going to discuss some of that which happens. We've got Rishi, who's written about Indian policy, and if I may use the word, we seem to have muddled through in a lot of these things. And then we've got an economy which, at least from the perspective of the two people in the sitting here on the panel, Ravi, who's done about, 600 deals in India and cross-border deals, and Sanjay, who's kind of seen, the market guru, who's seen that, so much global capital and global FII is chasing India. So you've got this. So we are hoping to discuss and tease out some of these trends which are shaping out and which we've seen shape out over the last few years. So let me kind of begin with where it all, the purpose, what got us all together. Rishi, you talk about, can you just dissect the title of your book and the various chapters and, where we are, and just elaborate that for the audience. I was hoping that we'd have the publisher here selling copies, but you'll have to order it on Amazon, I'm guessing.
I think it's there somewhere.
Oh, it's there?
Yeah.
Okay, so the publisher is there. Those of you who want can, but can you pique everyone's interest in the book at this stage?
Yeah, so thanks, Amit, and thank you, Koram, for hosting us. And so the book is called Slip, Stitch and Stumble. I know it sounds a mouthful, but there is a reason and a logic behind the name. If you look at it's primarily about financial sector reforms, and if you look at the history of financial sector reforms in India, we've had it now going for about over 30 years. And if you really go deep down into the reforms, split it open, you'll see that every time we have initiated reforms, we have hit a wall. And then we've climbed up the wall, and then the next time there is a crisis, we've again tried to reform again. So reforms have always been episodic in nature. They have always been provoked by a crisis. So therefore, you slip, and because you have this patchwork quilt approach to financial sector reforms, it's hasty needlework, therefore the word stitch. But the moment you try and get up and walk or run with it, you fall again, because you've not done the reforms, or you've not seen it to its logical end, and therefore you stumble again. And so therefore the book doesn't purport to be a history of financial sector reforms. I mean, it's not a laundry list of all the reforms in the financial sector. It just takes into account some of the big ticket items, like the capital markets, like banking, like NBFCs, NPAs, and the common thread that's running through all these sectors and the reforms in these sectors is that every action was provoked by an incident or by an episode. Reforms were not organic in nature. They were initiated because there was a crisis, because the government felt that there was a political need to do reforms. It wasn't big. I mean, initially in 1991, when reforms first began, there was a need to do reforms because the economy was in dire. I mean, we were like staring down a cliff, right? I mean, we had the BOP crisis, and we needed to open up the economy. And if you were going to open up industry, you needed finance to be opened up also, because industry, to succeed, to be able to get capital at really efficient at market-driven rates, not administered rates. You needed a financial sector that was fairly open, free from restrictions. And that's the impetus for opening up the markets initially. But after that, after the first flush of reforms, every piece of reform was provoked by a crisis. So therefore, slip, stitch, and stumble. Let me, stop here.
So there's no underlying philosophy. It's not that we've embraced the Chicago school saying free markets, or we've kind of said that, look, we need a Keynesian approach, etc. Is there some underlying philosophy, or it's just kind of muddled through? I've used that expression, and I'll keep coming back to it. We've kind of muddled through and said, okay, let's kind of try it out and see what happens.
Well, the thing is, the prescription for reforms were pre-existing the crisis, actually. I mean, before 1991 crisis, in the 80s, you had this constellation of economists and policy advisors in Delhi who had been advocating reforms. And this, to some extent, was also inspired by reforms that were happening elsewhere in the world. In the 80s, you had this famous term called LPG, which is liberalization, privatization, and globalization, right? I mean, and Thatcher and Reagan, that Western force had introduced this idea that, if you want to come out of the low productivity trap, you needed to do LPG. And so therefore, everybody in the world was taken up with this idea of LPG. And in the 80s, you had a whole bunch of economists and advisors in India. Montek had come, there was a whole lot of guys, sitting in Delhi who were advising government, writing policy briefs, notes, papers, that we needed to move away from the dirigist economy that we had earlier. And so that idea, that whole thought process had existed, was in place already. So when the crisis happened, they knew what to do because it was already in place. But to pin it down to one ideology, I think would be a little difficult because, maybe, yeah. So Keynesian economics had kind of died a natural death by then, especially the turn of the late 70s, early 80s. And Friedman was, one of the leading lights of economic, he was an inspiring economic figure for the 1980s for policymakers. So therefore, yes, some of the ideas were drawn from Friedman and some of the other leading economists who were advocating freer markets, open borders, and so therefore some of those ideas came from there, certainly.
Right. That's interesting. So, but we don't seem to have done, we've stumbled, we've stitched, we've built a quilt out there, but we don't seem to have done badly. And let me kind of bring in Sanjay and Ravi on this. We're, the fifth largest economy on path to become the third largest economy in a couple of years. So at some level, opening up unleashing the animal spirits which began in the early 90s through Manmohan Singh's budget, which is the, where you begin your book in a manner of speaking, seems to have served its purpose. And both of you have kind of observed it very closely, whether it is the capital markets, whether it is individual corporates who are now global in scale and size, whether it is attracting foreign capital to India. So, Sanjay, your take on that?
So, I think we started our careers around that time. I hope you can hear me. It's okay?
I think you need another mic.
You want this? No, I think they'll be able to do it.
Sorry. So look, if you have to think about the economic history of India, it can be encapsulated between 1991 and 2024. It was in May 1991 when the Chandrasekhar government started shipping our gold out because we didn't have any money. As a country, we were broke, and we had nothing else to give to the world to actually meet our day-to-day needs except for the gold that we had. And that devastated the morale of the country and the confidence of the country for maybe a decade or 2 decades or so. Fast forward, sometime in the last quarter of the last financial year, between January, February, March, from a point in 91 when we had to ship out 67 tons of gold abroad, we brought back our own 100 tons of gold back into the country. So this is the period which I think is the most interesting period. And if you think about it as a movie, the first half of the movie between 1991 and 2014 was the challenging period where, as Rishi also points out, we slipped and then we kind of stitched it together. We stumbled. Reforms were mostly half-hearted. There were a lot of scams, a lot of scandals. And nothing to do with any political ideology, but post-2014, I think what we are seeing is a very confident India. And hopefully when Rishi writes his next book, the title of the book will be Confident, Competent, Comprehensive. And the reason I say this really is that we observed it close up, the focus on macroeconomic balance sheet of the country, and we brought down our deficit year after year to now 4.9%. Even on a consolidated basis, we have brought it down to 7.7%, which is the lowest that we have seen in a number of years, number of decades in India. We are well on course to reducing our debt to GDP, and we are probably the only large economy in the world which is reducing its debt to GDP, which is at 80%, will probably go down to 70% or so in the next few years, at a time when Japan is at 250%, China is at 280%, US is at 120%. The focus that we have had on shifting the expenditure from revenue to capital and on infrastructure. Now, infrastructure spending is almost 3% plus of the GDP, and it's really being visible in the way roads are getting constructed, airports, and so on and so forth. What we have had the advantage of is that we had no legacy digital infrastructure. So in some ways, we started on a fresh, not on a clean slate in 2014-15. So the focus on the digital public infrastructure, the JAM Trinity, has helped us, of course, to leapfrog in terms of progress over the years, but it has also brought about a very interesting reform by stealth that is weeding out corruption. It was almost $200 billion of subsidies in this last 10 years have been given out directly to the person who, so to speak, deserves it without having any middleman in it. Then the focus on the focus on manufacturing, the focus on PLIs, the focus on having free trade agreements. So it seems like a very different country as opposed to what it was before the interval, as we say in Bollywood terms. So I, for one, am very excited. There are a lot of challenges, of course, in India. But let me just pause here by saying that, coining a phrase from this movie, Yes Boss, from 1987, अच्छे लोगों के साथ generally अच्छे लोगों के साथ अच्छा ही होता है. So I think for India, as far as I'm concerned, good things are going to happen, good things are happening, and far more glorious things are going to happen. So let me pause here for a moment.
So Ravi, your take, Sanjay, of course, is the young person on the panel. He began working after the reforms had been initiated. So were you working when Manmohan Singh gave his speech, or you were still a student and therefore you ignored it?
I entered the industry in 92, but I was involved with the markets since my engineering days in 85.
Okay.
And I know we keep saying Manmohan Singh, but we should also pause and celebrate the fact that the real architect of the reforms was P.V. Narasimha Rao, the Prime Minister.
Sure.
And the irony is that nobody talks about him. He's the unsung hero, even amongst the Congress party at this point in time. So, yeah.
Yeah, no, we're referring to Manmohan Singh because, the starting point of the book, etc., is his, what he said. And that, of course, is a separate debate. But Ravi, you've kind of straddled both eras, if I may use that word. Just barely so. But you had, one foot in the door before the economy started opening up. So your experience in terms of what you've seen, just walk us through those, the last 20, 25 years. What have you experienced in different roles in dealing with entrepreneurs? How has that changed?
Just a couple of points, Amit. First of all, to my mind, any reform has to be dynamic. Okay, all right. You learn, you change with situations because there are new global scenarios emerging. There are local challenges emerging. So you have to keep changing and keep reforming. Okay, and I'm sure if you look back, then you will see, okay, these things didn't go right or they don't go wrong. So that's one part, that reforms have to be always dynamic and forward-looking. Second, I think we should also spare some time to, as I think Sanjay alluded to see which way are we going directionally now to the numbers those are very tall numbers. And if we were to even come to 28 trillion or 56 trillion, as you said, what needs to be done, probably that's the most constructive way of debating in this evening. But I think I have questions since Rishi has done so much research and written a full book on that. I guess a few things I want to ask him. One, what is the reason for this, stumbling, post-stitching, correct? And is it lack of competence? Is it lack of vision? Is it lack of political will? Or is it that there has been too much of an influence from some, interested parties who did not let the reforms fly or proper reforms being introduced so that, their interest is not properly met or it's curtailed? Sorry, Amit, I'm asking a question.
I see it as a conversation rather than me leading the discussion.
Well, my simple answer to that would be read the book. But
Without having luxury of reading the book.
But okay. No, I think it's the influence of the political economy on, the system. And the prevalent or the overwhelming political economy of, each era has had its baleful influence on policy making. And it's prevalent even now. I mean, whichever government comes or which, irrespective and, agnostic of political ideology, political powers are subject to influence, right? And depends on how the influence works, where the influence is coming from, and how the political system responds to that influence. So reforms at all stages have been subject to influence from different, stakeholders. In the capital markets, for instance, it was under influence, the progress was stymied by the interested, say, broking community, the legacy broking community, particularly in BSE, Bombay Stock Exchange, which didn't want systems to change, which had a lot of stake in status quo. Change was much more expensive for them than status quo. So that's just one example. But at every stage, reforms have got, stymied or have been held hostage by various vested parties.
So let's,
That's an interesting point.
yeah, let's just stay with this. So, you've kind of alluded to two large reports. One is the Narasimhan Committee and the other is the M, which everyone presumes is the Monte Ahluwalia. Both of them would have been pro-reform, yet we held ourselves back.
Yeah.
Any comments on that?
No, so the M report came much before reforms began, in fact. The M report was moving, it was really moving the envelope much ahead of its time. And it is Montek's, it was a Montek report. And interestingly, the report was submitted to Committee of Secretaries and to the political system in power then for pushing policy initiatives, and it got buried. But for some reason or the other, it got leaked to the media. And so, to the Express group, and both Indian Express and Financial Express carried the full report. And basically the report was saying that, if you want to move the economy out of this funk, these are the 6 things you need to do. And, fortuitously or just by serendipity, the kind of reforms that were then attempted post-91 actually were very close to what the M report said.
Interesting.
Can I just make a point, Amit? I think if you look at today's whatever, 4.5 trillion, 5.5 trillion market cap or economy of 3.5 trillion, I think that 5.5 trillion, if you cut this thing, 90% of that is owned by 500 companies, 75% of that is owned by 200 companies, and I'm sure if you look at a smaller number, say top 50, 60 companies, there will be again a significant portion of it. I think the question to be asked also is that at this level, if this is the structure which we have achieved in the last 75, 80 years, fast forward 200 years or to 2047, do we want the same structure where top 50, 60 groups are going to dominate 60% of the value to be created? Or is it to be broad-based and therefore the commensurating reforms are needed? I think that's probably, to my mind, more important. Otherwise, I see, and maybe Rishi, you've done, again, research on that, and as to what kind of a structure you see evolving.
But let me kind of first,
Yeah.
point it back at you. What would you think would be ideal for us?
Well, it should be more broad-based. If there is value creation, if there is wealth creation, we are a true democratic country, we want to eradicate poverty, we want to uplift our people, we want to give them jobs, we want to give them better livelihoods, we want them to equally enjoy, the growth which we are aspiring. I think it should be more broad-based. But standing today, looking into the current structure and fast-forwarding it, I think it may not be the structure unless through, again, reforms, concerted reforms, you make a switch, a serious switch to make it more broad-based. Otherwise, access to capital, access to technology, access to ideas, access to licenses, everything is restricted to, as you alluded to the fact that, there are a few, people who have influence.
But is that kind of, is it something which is directed through policy, or is it just the way that, as they say, things have worked out?
No, I'm sure there will, you need policy initiatives to, drive this at some level because, you can't leave it to market completely. And as we've seen over the past 14, 15 years, that markets are not the perfect instrument to deliver all benefits, right? Markets are not what they're made out to be. Markets need to be regulated, and free markets is a utopian ideal, right? There are no free markets anywhere in the world. Having said that, so just going back to what Ravi said, I mean, we may be the fifth largest economy today in terms of nominal GDP basis. But if you slice it down, we have the lowest per capita GDP among all BRICS countries. So our per capita GDP is just $2,400. And we are in what economists and what World Bank calls the low middle income trap. And we really need to make concerted efforts to get out of this trap. And one of the things that we need to do is to figure out how do we employ the large number of youth who are not employed.
Sanjay, I think you want to come in on that. And
I
just
think-
a quick comment on what Ravi said. So the Korean, that's one of the few countries which kind of escaped the middle income trap. And they focused on having 4 or 5 large corporations, the chaebols or whatever chaebols, which they're called. It seems to have worked for them. So Sanjay, you want to come in and your take on that?
So look, South Korea as a political economy is very different from India, just given the size of the economy. And I think it's just a coincidence that those chaebols out there, and by the way, the chaebols in South Korea have 53% of the market cap of the country. And the top 10 corporate groups, if you were to just exclude Tata's for a moment, because it's a group of loosely independent and professionally managed companies, is not more than 25%. So the top 4 or 5 chaebols in South Korea have 53% of the market cap, and the top 10 groups in India have about 20-25%, which is not very concentrated, contrary to what we intuitively feel, because the evolution of the economy through the birth of many such companies like Zomato has changed the contours of and the composition of the market cap. But the very important point that Rishi raised is to how do we escape the middle income trap? And he's absolutely right. I think rather than rejoicing the fact that we are a $4 trillion economy, will be $8 trillion economy, we have to be mindful of the per capita GDP. And the per capita GDP in nominal terms is just at $2,500 right now. But the good thing is that it's actually improving at the fastest rate amongst all the BRIC countries. So there is a balance sheet item, which is $2,500, and there's a flow item. That's the rate of change. And I think as observers of markets, of economies, we pay equal attention to the actual number as we do to the flow. So India must be doing something right in terms of the policy framework for us to improve and to evolve. More importantly, there are 34 countries which have escaped the middle income trap since the 1970s, 1980s. And each of these 34 countries have focused on 3 things. It's called the 3I, and that's invest, infuse technology, and innovate. And I think these are the things that India has to focus on. We are already seeing a substantial amount of focus on that. And sometimes it goes unnoticed, but just take a step back and think about what we have done in the last few years. We are one of the first, in fact, we are the first country to have a rocket land on the dark side of the moon. We are one of the cheapest in terms of cost in sending a rocket to Mars. We are one of the first countries in the world to have a private sector entity in the form of Agnikul to have a 3D printed rocket running on liquid oxygen and ATF to go to space and back, and that's been done at a fraction of the cost at which NASA has done. And there are similar examples of technology, application of technology, and innovation that we can see in many aspects of our life and in many sectors, so it's not just one. So India is a very interesting case where we cannot superimpose any of the Western examples, any of the other examples in Asia, including South Korea or China. India has its own way, India evolves in its own way, and at one point, which is where I think we've reached right now, the unleashing, maybe not of animal spirits, but the unleashing of innovative spirits happens. And that's what probably will help India propel forward, if that answers your question to some extent.
Amit, may I chime in? I think, to my mind, and if you look at the same stat of per capita, $2,400, $500, if you spread it on to the market cap, this is GDP, if you do it, market cap is $5.5 trillion, will be $4,000, correct? But the fact is the point which I mentioned, I think the delta between 2.5 to 4,000, is accrued because of the wealth being created, which is very concentrated as of now, correct? I agree. I think we need to unleash all the, powers which India has. And entrepreneurial power in this country is immense. Innovative power is immense. All they need is the right framework as well as also the right policies which sort of allow them to operate freely, correct? And access to capital, of course. I think maybe during the discussion, one of the points again still we should debate about it is why, if we are sort of growing at a rapid pace, we are the best performing economy in the country, and I hope we will continue at the same clip. Why is the FDI not flowing in? It's very counterintuitive, and when we are such an attractive economy, then FDI should come in, in impactful. Why is that not coming? Why is it that, foreign companies, there are two different types of foreign companies. Some foreign companies who have presence in the country, they know how to navigate it. They've sort of learned the tricks and, learned how to operate in this very dynamic and, environment. But the new ones who may have access to technology, who may have a lot of capital, who can give us access to various markets, why are they not coming in, bringing in capital, bringing in people, bringing in technology, products, and access to future markets? I think that's the point we need to think through.
Sorry, I just wanted to add one more point because we're talking about per capita income. I think somewhere we lose sight of the fact that the true measure of per capita income is not the one that we use in day-to-day life, that's the dollar terms. It's really the purchasing power parity. Because I think we are heading to a world where the dollar is going to probably lose its relevance. All currencies do at intervals of 100 to 150 years, give or take a little bit. It happened to the pound, it happened to the Dutch, it's happening to the dollar now. And whenever that happens, we go back to the gold standard. So when we think about purchasing power parity as a true measure and a reflection of how rich or poor a country is, in today's dollar terms, we are at already $9,800. So yes, we have a lot of way to go, and there's a lot of things we need to do, and by no means is it a picture-perfect scenario, but it's not as dire as it seems when we try to think about it in terms of the statistics which usually get presented to us.
So I'm going to, on your comment, Ravi, I'll just come back. I had a conversation with Deepak Bagla, who was at Invest India. And, at that time, there was a lot of, and there still continues to be a lot of buzz on the startups and how many have become unicorns and so on and so forth. And one of the interesting observations, or, one of the unique observations, I should say, which Deepak had to me, was that, look, we are not measuring how many unicorns are there. We are saying in each of the districts in India, how many new startups are formed and how are they progressing. So, when we keep talking about the large 5, the 7, the 10 companies, we have to recognize that while all of them are growing, and maybe the middle is kind of, stumbling, to use Rishi's phrase, or not growing as rapidly, it's a lot of the entrepreneurship which is happening at the startup, the entrepreneurship, the drive which these young people are showing, which is going to be transformative as far as our future is concerned. We've been discussing quite a bit, but do any of you have any questions at this stage before we move on? Okay. Sure.
Jayakumar, come sit here. Can't see you, man.
No, I just.
Come sit here. Sit here.
Or why don't you just, or if you can stand up, we should be able to.
No, I just random comment. We have to be careful when we measure ourselves by this purchasing parity theory. The quality of the road I drive is very different than the quality of the road in the US. The quality of the train I sit in is very different. The water quality I get is bad, is what it is. You walk around, look at number of children begging. So I think we have to be careful. All I'm saying is we should be happy about progress we have done, but unless we are dissatisfied, and unless we deal with the reality, we'll just be deluding ourselves with picking up facts here, picking up facts and putting it together. We have a problem. We should recognize that and then deal with it. This purchasing parity and all is a bit of a mixed thing in the sense that you have to compare like for like. And would these products be acceptable in those markets? I have to think about that as well. That's
a wider debate. So yeah, there is we can look at it, but I think at this stage when they kind of measure things like purchasing power parity, it's much more basic in terms of, how much does a burger cost or food items, etc., etc. But sure, the quality of life is also something which needs to be focused on, and hopefully with the passage of time. And feel that a lot of these are at what you have to focus on is the inflection point. One would be $1,000, then $2,500, then $5, and then whatever it is. With each step, the quality of things changes, and the expectations also change. So, growing up, what we would accept as standing in line, getting up in the morning for milk, buying milk, or, waiting for a phone connection, waiting for a car or a scooter. All those are things which we now take for granted. So hopefully over a passage of time, whether it's the quality of roads, etc., or drinking water, quality of air, hopefully we will start to address those. All of those come with an improvement in the purchasing power of the citizens. So let's come back to a question which, Ravi, you alluded to, which is that why isn't FDI coming in, etc. That's a more, something to be thought about. But we know the FIIs are not coming in to India in the large numbers. So Sanjay, do you want to weigh in on that?
Yeah, I think part of the reason is that most of the action has been in the US, and particularly with the Magnificent Seven, and the optically strong dollar. And when I use the word optically strong dollar has actually been losing value against gold, which is traditionally the standard measure of value, significantly over the last 20 years. But in the land of the blind, the one-eyed is the king. So in the currency world, a dollar has just been strengthening over the years in spite of all the problems, and perhaps because of all the problems that the world has seen. So there's no real reason for the large pool of money which is there in the developed economies to go outside of the US and the developed economies. That's one. Second, the challenges that China has faced and investors have faced in China has also led to a lot of reluctance on their part to put money in emerging markets, because most of the indices over the last 10, 20 years have been all emerging market indices. It's only now that in the last few years we've seen the birth of emerging market ex-China, just given the geopolitical challenges that the developed economies in the Western world have with China, they have with Russia. So I think that's one. And second, with all that's happened in the last few days, particularly the reversal partially of the yuan carry trade, this is the first time that we had a crisis in the world in the last 20 years where the dollar is not really appreciated, but it's actually depreciated, which probably seems to indicate that the global investors are just about willing to step out of the US, out of the Magnificent Seven, and international flows might just accelerate. But in some ways, it's good that the global flows, particularly on the portfolio side, have not accelerated. It's a different story on the FDI side, and you're right, we really need to up the ante on that, and hopefully that happens, but we need to do a lot more for that. The reason I say it is that you want the market breadth to expand, and there's an absorptive capacity that the market has, as does the economy. And we already have almost 2 lakh crore rupees coming in from domestic investors, mutual funds, insurance companies, EPFOs, so on and so forth in the market. Sorry, almost 3 lakh crores, not 2 lakh crores. And we don't have enough supply of paper. Even though the paper supply has been accelerating, it's just about 2 lakh crores. And there's a very interesting report by SEBI, which has just come out a few days back, that if we just have significant portfolio inflows without supply, then the market will become deeper and deeper, and we are going to go into more and more overvaluation territory. What we really need is a balance in the market breadth to expand. So it's in some ways very good that foreign investors have been not coming to the country. They have been actually selling at a time when the domestic investors have been buying, but I suspect that's probably going to change in the next few months or so.
I just want to add a few things, Amit. First of all, a simple answer as to why FII flows are not coming in lighter vein, just because Mr. Sanjay Shah is not doing it. Okay, he was instrumental in getting a lot of FII flows into the country. He may be modest, but I can say on his behalf. But I think a couple of things. First, of course, FII money, and that's why I alluded to FDI because it's more sticky, more permanent. FII is like hot money, right? It flows where there's an opportunity. So first, of course, in their wisdom, the foreigners find that our markets are expensive. And I can't blame them because they are, and Sanjay can support me on that, and they are, very, very intense research-oriented people also. So they probably find it, maybe on a relative basis, we are expensive. Second, of course, we've seen it multiple cycles that whenever the interest rates are high in the US, there is a reversal of capital from a lot of emerging markets where I think the risk reward doesn't balance, so when they put risk premium on emerging markets, then I think they find that investing in fixed income is a better opportunity for investors, particularly when the interest rates are high. And third, of course, I think we should never forget that there is a virtual competition for that capital, correct? So as we speak, if China is looking very attractive in terms of valuation, correct, which it is, or if Japan and Korea is looking attractive, then the money will go there. The money flows in and out, correct? So I think that's the nature of the beast. But in a way, I think we should also thank the FIIs for withdrawing the money. Otherwise, our markets would have gone to a crazy level. Of course, whenever they will come in, they will pay a premium to come in, and markets will just roar when FIIs come in. Thankfully, they've withdrawn money so that there is some semblance in the market. Otherwise, this market would have gone crazy. Now, having said that, I think one of the structural change, which I'm very happy to see, and I think we must applaud that, whatever has happened because of the financialization of market or formalization, I think the big structural change which has happened, if you recall, 10 years back, during our times when we used to do banking capital markets together, Amit, if FIIs were to withdraw $1 billion from Indian market, Indian markets used to rattle. They used to fall like a falling knife, and nobody wanted to catch it. Now, FIIs have withdrawn $20-30 billion, and nothing has happened because the structural change which we've seen, that there's a lot of financialization, formalization of the economy happening, and financialization of savings which is happening, which is getting into the market, and I think that's probably saved us. So I think that's point we should also debate, that this structural change, how did it happen, and is it for good or is it temporary? Of course, it has its own flip side. A, it has driven the markets to a new level. B, I think it is also a trapped cash syndrome because there's so much of a savings coming into the market that it's a trapped cash. Mutual funds cannot not accept the cash. Mutual funds cannot not invest the cash because if they sit on the cash, they will be on a relative basis less performing. And mutual funds do not have other asset classes to invest. And I think that's the point we need to see as to what is the next level of reform to meet this new challenge, which is a good challenge, which has come in front of us. Should we introduce more paper, new issuances? Should Indian corporates raise more capital and again new paper? Should the government divest more aggressively, which they should to my mind because every stock has gone up 100-200%? Or should selectively, we have opened, but should we allow mutual funds also to go into other asset classes and also maybe offshore and start giving Indian investor a flavor of the international market?
A lot to think about. We'll come to it. Let me kind of...
Just to add to what he said, or rather to endorse what he said, supply can happen naturally, supply of paper, or it has to be engineered so that we don't have market bubbles. And one of the better ways of doing it in the interim while the national supply accelerates is to engineer a supply. And the easiest way to do it is by selling some of the stakes that government has in many of the listed companies, which have gone up like 2-folds, 5-folds, 10-folds. So probably that is one of the most obvious things to do at some stage.
There are lots of them because one
second,
things
Amit,
which-
sorry, so in all of this discussion about paper supply, why are we just focused or obsessed with equity? There is no debt, right? I mean, the debt market remains as shallow as it was like 20 years ago. Your corporate debt market, despite multiple reports, committees having come and gone, is still a very shallow market. It's, the biggest supplier of paper there is one entity called the government. I mean, and if you look at, say, business cycle theory in India, there is ample evidence to show that companies do not raise money from the market till the business cycle reaches its peak. Because what they're doing is basically collecting reserves and surplus to provide equity for the next project. But by the time they have amassed, enough surplus, it's time for the market to fall, and then they're left holding, a bad paper on their books. So if they wouldn't have to do that if there was a robust, deep corporate bond market in the system. They wouldn't have had to rely only on banks for financing. So, this obsession for supply of just equity, I think is in some ways, it's harming us. It's, making us vulnerable to cycles, to bubbles and busts. And I think we need more corporate, a deeper, more vibrant corporate debt market.
So, this is a little bit like the cricket, the focus on cricket and the money which goes into cricket kind of sucks out all the energy from the other sports, right? Yeah. So if we are kind of bemoaning our performance in the Olympics, we can say that, look, because all the money is kind of gone into cricket. So that's where we are. Yeah, Alok, let's.
So I have a point of view across, I've been here since the 90s, but it's okay. But the question, it's a Rishi show, right? So I will read your book because I don't want that answer. Now we've talked a lot about the past. I'd like to understand, if it's not in the book or it's in the book, I'll read it. What is your prescription for the future? I mean, you've talked to a certain extent about the debt markets. We've talked about equity at length. I think it's now, we've talked enough about it. What do you feel, with your experience in writing the book, how do you see India moving forward over the next 10 years?
Alok, we'll come to that.
Okay, sorry I interrupted.
We'll come to that in 5 minutes. But before we kind of come to the question which Alok asked, I have a question for all of you. Is it that we've got a nanny state? The regulators want to kind of control us too much. They're kind of worried about what happens. And the second question is, in terms of the quality of the data they use for decision making. And just your thoughts on that. So I know Sanjay and we had a discussion a couple of weeks ago in terms of this whole thing on the futures and option market, and are they looking at the right data set? We've suddenly find that they've sprung the surprise with regard to the long term or taking away the indexation benefit on property. So do they kind of think through, use the right data? That's one. And the second is this whole thing, in terms of banks, you don't want more banks, license more banks because you're worried about the fact that there's going to be bank failure. You don't want corporate sector to be in banks. It's a separate debate whether it's good or bad, etc. But are we too protective of, I don't know what, saving the man on the street or whatever, and therefore not growing rapidly enough? Thoughts on that?
I'll let the regulated speak first.
So look, in the period before 2012, 13, 14, we had a telecom scam. We had a near-death experience in the banking sector and in the shadow banking, that's the NBFC sector. We have had scams in mining. We have had scams in energy, power. We had scams in natural resources. So it's a laundry list of the scandals and the scams we have had.
If you look at the book, he talks about Nagarwala and
you
a host of.
It will require one complete session to go into all of them, right?
There's a reference to a lot of the scams in his book, and that itself has, as Rishi said in his opening comments, an impact on the regulations today.
So it's incredible that we are where we are in spite of all the scandals. Somebody up there must be loving us. So that's the first thing to say. But look, a large part of the scandals and scams could have been avoided with proper regulation. And I think we were probably a bit under-regulated at that time. And because the memories and the scars of all those experiences are still so fresh, 10, 20 years is still a short period of time, I think we probably go through a state, and it's behavioral psychology, that we're going to see some over-regulation because we're always worried and we always have our eyes in the rear-view mirror as regulators. We don't want this thing to happen under our guard. We don't want that thing to happen under our guard. So it's a natural state, and the bond of trust between all the stakeholders takes some time to establish. And that's a challenge, and I think we'll just have to kind of tide through that. I do agree with you that in many cases we don't look at the right data sets because there have been so many headlines, just to talk about futures and options, and then maybe I'll give it to Ravi to talk about a few more things, and Rishi. There are so many headlines about billions of dollars of options being traded, retail investors losing millions of dollars, and somebody said it once and then it carried on. In this age of digital media, it just keeps on proliferating, and then there are examples of somebody who's lost a few $100,000 and so on and so forth. It's tragic. Even one person losing money is tragic, but let me just put the statistics in context. The total amount of cash trading in India is about $18 billion on a daily basis. The futures trading is about $25 billion. And the options trading worldwide is never really counted in terms of nominal terms, which can be trillions of dollars. Doesn't matter. It's always counted in the terms of premium traded, which we have discussed. It's slightly technical, but in terms of premium traded, it's just about $8 billion a day. Now, does this warrant us getting panicky about what's happening in the market? Perhaps not. The irony of it is that we may have used the wrong data set and we may have probably panicked a little, or at least become more anxious than we should be. But again, the irony is that some of the remedial measures, if you might call them that the regulators proposed, make a lot of sense. It makes a lot of sense not to have tons of multiple weekly expiries. It makes a lot of sense not to promote and encourage zero-day expiry. It makes a lot of sense to pay the options premium upfront. So regardless of using the wrong or the right data set, and regardless of whether we become too anxious or not, I think the end outcome is not so bad, and it actually promotes a very healthy capital market, which is a very unique thing to happen. We might use lots of wrong data sets, and we might have a lot of wrong connections. Eventually, we end up doing probably more right than wrong.
That's a very positive. Ravi?
I think Amit on FNO, I think Sanjay said quite a few things, so I won't repeat. I think in general, what we need to see is that I think right now retail investors are rushing in just because there is an inherent inbuilt leverage, and they're just rushing in. And again, whether it's the right data or wrong data, I don't know, but SEBI is proclaiming that, very significant portion of retail investors always make losses in the FNO. And still people are rushing into this. And I think that probably is not very healthy because I think, when the train stops, it is going to hurt so badly that we will sort of go back many steps, in terms of when a lot of households will lose their, much earned, hard-earned money, saving, houses, whatever they're putting in. So I think that's probably we need to be careful. I don't have a solution to that. But I think to the point what you said, and I strongly believe, if you look at it, and Jayakumar is here, he can support that, this country needs, to the banks, you said, this country needs many, many banks to, reach to the level where we want to be. Right now what is happening is there are so-called at least 6 public sector banks which are probably in size, which can fund this growth. There are 6 private sector banks, you can count them on fingers, which can fund this growth. And of the NBFC cluster, there are about 6 meaningful NBFCs, correct? Give or take 20. I think you see any country's growth path, I do not think that we have a sufficient banking system to fund this kind of a growth. I think that probably I think we need more banks. If we fail, we'll fail. We'll deal with it and we'll move on. Yes, bank happened. We dealt with it very nicely, and it sort of turned around and we moved on. But I think we need more banking sector players. We need to the point of innovation and all that. 5 years back, during COVID, I called a friend of mine in Singapore and said, okay, I'm preparing a bid for a digital bank. Why can't we have our own purely digital bank, which Singapore had. They gave 4 or 5 licenses there, tiny country. Why can't we do that, the same progressive stuff, What is stopping us? There are a lot of people who have applied in the last 7, 8, 10 years. You talk to the regulators, they say, we have fair policy, we will evaluate, but no one has till now qualified in for a new license. So do we need more banks and banking sector players to fund this growth to a level where we want to go? I think that's also a question which is needed. Otherwise, maybe Jayakumar, with your experience, you can add something if you can.
You
but
want to
my
come in
mind-
before I move to Rishi? On. Okay.
And not only with respect to banks, also with respect to insurance companies.
Yeah.
The rate, insurance requirement in Assam is not the same thing as is in Tamil Nadu. So I think the financial sector in general, more might be better.
Yeah, so, just taking on from what both Sanjay and Ravi said, I think your two questions about banks, number of banks, and the regulatory experience, I think both are linked in some ways.
So my question was that, look, A, the nanny state, and the second is the data which they use to kind of reach the conclusions they do.
I think our regulators are still, learning. Regulators everywhere are always a step behind innovation, But our regulators are trying to learn, and I think some of the steps that they've taken in the recent past in terms of, grappling with new technology, which is creating sandboxes, and the, renewed emphasis on SROs for each, sector of the financial system. So, kind of SRO for NBFCs, for fintechs. I think these are admissions by the regulator that we have a capacity problem, right? And it's best that we allow the industry to regulate itself as the first level of regulation. So they're going through their own learning curve. And banks, I think, they have also been singed by experience. We've had this terrible experience of the past where we've seen huge number of, pre-nationalization at least, there were a large number of bank failures. I mean, if you go through the RBI history, the 4 volumes, you'll see the number of failures that preceded nationalization. And that's history, I agree, and things have changed. We're very different now, but muscle memory in the regulator goes back many years. And one of the things that I guess, I'm just assuming here, that one of the things holding back the regulator today is there are no dearth of banks actually. I mean, if you put together all the public sector banks, the private banks, the foreign banks, the cooperative banks, the rural regional banks, the small finance banks, you actually have a large number of banks, and the NBFCs. But the problem is they're all thinly capitalized. And and I can tell you this, I was associated with one of the applicants for a banking license. Most people do not have access to capital. And they do not have a line of sight into future capital. When asked to provide, where they're going to get capital for in the next, say, 5 years, 10 years, there are no clear answers. And as a regulator, if a bank doesn't have a clear line of sight into future capital, that is a red sign for me. So I think some of these are, the other thing is, the RBI also is chastened somewhat by the political presence in, say, cooperative banks or regional rural banks, and even, say, public sector banks. And so therefore, it doesn't really want to, push the envelope there.
So some of the problems do seem intractable as of now, but I guess the way, and maybe I'm paraphrasing Ravi, is the question that, look, if you have 5 large corporations who want to borrow, you don't have sufficient number of banks who will be able to lend to them because they run into exposure limits, counterparty limits, single lender limits, so on and so forth. So that is the challenge. And, the issue which you raised, which is that, this obsession with capital markets, but not the other parts of the financial system, is coming from the fact that I'm sure if you'd ask the bank, and even RBI says it, that look, sooner rather than later, you need to IPO yourselves and not have an identifiable promoter. And this is some of the issues where,
going back to what Alok asked.
And so, maybe we can, I'm mindful of the time, so maybe we can all just quickly move towards the, what is it that we should expect in terms of regulations?
One of the things that, if you have a really robust, deep, this is something that we've discussed over 30 years, that you do not have a deep, lubricated and a meaningful futures market in interest rates. You don't have an interest rate derivative market. And unless you have a good, well-functioning interest rate derivative market, you can't have a good bond market. And you don't have a good interest rate derivative market because, again, you have a government which borrows 60% of the paper that's available, you know. So, yeah, sorry, go ahead. No.
So I think, Amit, having said all whatever said, I think the point is right now, the economy has propelled 7.5% in the last couple of years. Despite the news reports which are coming in that private sector has not been investing in a big way. I think it's the government which has invested in infrastructure in other places, and thanks to the PSU that the economy has propelled till now. The good news is that I think over the last 5-7 years, this is the first time we are seeing a confluence of banks having the meaningful banks, the banks having a very healthy balance sheet. The baggage of the NPAs and all are gone. And even if there is some left, because I think given the interest rate trajectory which we're going to see in the next 12 to 18 months, that will also accrue a lot of gains to them. So banks will have a lot of muscle to lend. Simultaneously, I think the corporate India, the private sector in India has seen balance sheets getting repaired. I think they did get some damage during COVID, but post-COVID, I think they've been conservative in investing, they've been cutting costs, they've been saving money, so that balance sheet was also very robust. So here's the situation here. The government is cranking in terms of spending. The PSUs are obviously under government's power, so therefore they are being encouraged to extend. Banks' balance sheets are good. Money is coming to the market, capital is available. Private sector balance sheet is quite repaired and they are ready to invest. I think we need to do more work on getting the foreign companies to come into India. We need to do more work to unleash the entrepreneurship by giving them so-called level playing field so that they can also flourish and participate in this massive value creation which we're going to see. So I think there needs to be done, but this is probably the best time, and that's why to my mind we are at an inflection point where we can grow rapidly should some of these things happen. I think the consumption is given for decades. We're going to consume. We are under-consumed economy. We are less penetrated economy. So on and so forth. So
Sanjay,
I think everything is stacked up.
I think I agree with Ravi because I think when you look at the various stakeholders, we got the best government balance sheet that we've had in 2 or 3 decades. We got the best banking sector balance sheet that we've had in probably 3 to 4 decades. And we got the best corporate balance sheet that we have had in a number of decades. I think the propensity on the part of the corporate sector to consume debt to grow is very low because again they've been scarred by the experiences of the last 20, 25 years where they, at some stage, particularly between the period 2005 to 10, they borrowed mindlessly. So it takes time for those memories to fade and for them to have the confidence to borrow. So I completely agree, we need more banks, we need more supply, but I think the challenge for the debt market is as much a demand issue as it is a supply issue. And we need the corporates also to step forward to fund their capacity expansions, to fund their working capital, and to try and consume more debt. And hopefully the twain shall meet at some point. But there's a lot more work to be done. And mostly because the Reserve Bank of India has been much more shy than the SEBI has been in terms of opening up the markets, given that debt inflows can be far more challenging and can leave you much more vulnerable, as we've seen in the 1998 crisis with emerging markets in Asia and so on and so forth. So I think it's a gradual process, but I think mostly it's definitely a supply issue, but it's also a demand issue.
And just to add, Amit, one more point, this Goldilocks situation where the government is getting excessive dividend from the RBI. The GST is growing rapidly and is a very robust collection. Tax collection is growing 20-25%, though I must say that we can debate separately whether this country needs more taxpayers. And finally, I think the government could not divest in the last 24 months to 36 months, whatever, but that's a blessing in disguise because now shares have accreted 100-200%, as I said, so they can do aggressively sell down and generate more resources. So there's no dearth of resources right now from the government pocket as well. And I think if we add to that private pocket, entrepreneurs pocket, foreign direct pocket, I think this country can go places.
But Amit, let me just add one more. Sorry, you want to go ahead?
No, I'm saying it's still, sorry, go ahead.
Okay. So, Amit, we talked about what can be done, what should be done, but I'll tell you what will be done, in my opinion, based on whatever my discussions are. The government is not keen to accelerate growth beyond the current rate, and which is why, if you notice carefully, in the current budget, they have forecast growth for 24-25 at 6.5 to 7%, in spite of good monsoons, in spite of the fact that we grew at 8% plus last year. The government is just not comfortable accelerating growth beyond a certain point because they are worried about potential disasters which might greet us if we try to grow in a very accelerated fashion. I don't think, again, even though it's the right thing to do, the ethos of this government is to divest state-owned enterprises. So I suspect we should not, even though it seems to be the logical thing to do, expect too much on the divestment front. So I think there are a lot of things that the government should do and could do, but they might not do it, just given, again, the experiences of the last 10, 20 years. And it'll take some time to reach a point where we kind of share those experiences from our memories and kind of march ahead.
You know, somewhere we've not answered the question about why FDI isn't coming into India, and as a corollary, why isn't private sector investing? Because, you know, if government has been investing so aggressively for the past 4 or 5 years, why isn't private sector taking up the slack? And I think, you know, there are some very obvious answers to that. And I think one of the, say for FDI, for instance, I think they don't like shocks. You know, foreign investors don't like shocks. And we are an economy, you know, irrespective of political party in power, we love shocks. I mean, we love taking sudden decisions which really shake up the market. I mean, demonetization was one very clear unilateral decision, you know, which, you know, shook up the market. And then soon after that, a very flawed GST regime was introduced, right? Which wasn't necessary at that point, just soon after demonetization. Neither was demonetization necessary. I mean, it was a political decision. But these are shocks. I mean, we love, you know, introducing these shocks to the market, which are unpredictable, which really, you know, rattle markets. You look at budget after budget. We tinker around with tax rates. We do not do enough stakeholder consultation on taxes. Your GST rates are, you know, out of whack. There has been a lot of discussion about rationalizing and, you know, getting all the GST lines aligned, GST rates aligned, but nothing is happening. You do suddenly, you know, you change GST rates suddenly on some items. You have these discussions which investors. So if I'm an investor and I'm watching from outside, I want some certainty. I want some stability. I don't want these shocks because my money is on the line, right? And private sector, again, Indian domestic private sector, I think, also suffers from the same apprehensions. You know, if I put in my money, are there guarantees that I won't be victimized tomorrow? Are there any guarantees that, you know, I won't face sudden tax issues? So I think these are, you know, these are issues that stare us in the face and we need to talk about them.
Look, I'm very mindful of the fact that we are close to, you know, well beyond how long we expected to be here, but it's been an engaging discussion. So I'd just say that, you know, to summarize it, we kind of seem to be disappointing, as they say, both the optimists and the pessimists at the same time. But just end up by saying that despite the state and despite what the government has done, we kind of seem to have, you know, slipped, stitched, and stumbled into what only seems to be a rosy future.
You know, I had a friend from Gorakhpur who once said, ki, yaar, you know, sorry, I'm going to lapse into Hindi. You know, our country has so much dynamism कि किसी भी गधे को बिठा दो, country will grow by 6%. So, you know, that's the optimism, you know.
I think, Amit, I think if we have to achieve the so-called Viksit Bharat in 2047, what you said, I think time is now to accelerate, to Alok's point, to really accelerate reform, to crank up on all fronts of investment, to open up the economy more rapidly than what it is opened up. And I think other countries have proven, China was a glaring example of that. And I think, obviously we have to learn some lessons from what they did and do better. But as we grow, it will be an uphill task to, get to that number, what you said. And a lot of things need to be done here, whether on the banking side, financial markets, capital markets, to my mind.
As far as policy is concerned, our glass is half empty, but as far as outcomes are concerned, our glass is half full. So let's...
Yeah, so look, I think if in the 90s and the 2000 period, we were probably going 2 steps forward, 1.5 steps backward. Now, I think it's safe to say that we're going probably 3 steps forward and 1 step backward. So that goes back to the point that India will disappoint both its optimists and pessimists. But I think there's something in there. Maybe it's just the culture, it's just the economic fabric, the social fabric. But we are not in such a bad place as what we ought to have been had we just focused on all the things that have gone wrong in the last 30 years.
So last word to you, Rishi.
No, I think, there are still large number of reforms left to be accomplished in the financial sector. Regulatory imbalance is one big issue that's, today you have banks and NBFCs, which are, lending banks, credit dispensing banks and NBFCs, which have to follow a huge list of regulations. But you have mutual funds and PEs which can lend freely without any of those restrictions. So that's a misaligned market. But on the broader economy, I think what Ravi said initially, there is a problem. We have uneven growth. We have a lot of inequality built into the system. And unless we get, we work, really get down and sort out this inequality. Today you have about, the latest ILO report says about the number of educated youth joining the unemployed force has been rising year after year. It's now about 60% or thereabouts. And I think that's really worrisome for an economy as large as India. And I think that's should be the clear focus.
So anyway, the message is clear that we have our work cut out for us, and on that, let's bring an end to the discussion. They're going to buy the book. So.